All right. Well, hello, everyone. My name is Adam Nishikawa. I work for Exchange Resources. We are a 1031 exchange accommodator. Today, I'm just here to really give an update on everything that's going on in the legislative, and as well as a little reminder or refresher course, if you will, on the 1031 exchange. I know with all the rising home prices and investment property prices, people are looking to defer those taxes, as well as the threat of not being able to do it in the future is definitely going to drive some investors to make their moves now. So definitely very timely for this presentation. I always like to start off with a simple definition. For those of you that don't know what the 1031 exchange is, it is a transaction which allows your investors to defer the payment of their capital gains tax as long as they're exchanging investment property for other investment property of equal or greater value. So I really want to unpack, like why would your investors come to you for this particular service? And that's the potential tax liability. I mean, for the most part, your investors are facing a pretty steep tax liability, especially being here in California compared to the rest of the country. So if you break it down here, you're going to have your long-term capital gain tax, which is up to 20%. And that's going to range based on their income. That could be 0% if they are not earning anything, 15%, or 20%. And then you're going to have the affordable healthcare surcharge tax, which is 3.8%, and that is still there. And that's the Obamacare tax. And then for the length of the ownership for your investors, they have that depreciation recapture tax. Basically, your investor owns a property for 10 years. He's been depreciating it every year for 10 years, and they want 25% of that back. And then California has the highest capital gains state tax rate, which is 13.3%. That's higher than every other state. So these ratios obviously can change based on where they're exchanging out of, but this at least should prompt your clients to, consult their CPA, learn their overall tax liability. That way you can help advise them the best way to reinvest those proceeds. Second part of this definition, like kind investment property of equal or greater value, what qualifies as like kind. So you're really not going to be limited. It's any investment property, single family home, land, multifamily, commercial, the usual options. You'll see the Delaware statutory trust a little more these days. And if you have any clients going into New York, they're going to have the co-op. But also, you may have some clients that are leaving New York, coming to California. They may be currently in a co-op that was an investment, and they're deciding, they're going to sell it and move that over to California. So that does qualify. It's a 30+ year lease. What does not qualify? Personal property, stocks, the 121 exclusion, for primary residences. Primary residences don't qualify. So if it was their primary residence for 2 out of the last 5 years, then they'll get that 121 exclusion. If it was a duplex and they lived in one unit and they rented out the other side, they would get the 121 exclusion on half the property, and then they would be able to 1031 exchange the other half. That goes for any size property. If there's a rental or investment aspect to the property, there is some eligibility for a potential 1031 exchange. So that's why it's really important that they consult their CPA and just get a refresher on how they've been filing taxes and what that means to them. One of 3 key things to remember for a 1031 exchange is just title. Just please keep in mind, if your clients hold title, as John Smith, they need to go buy their new property as John Smith in a 1031 exchange. A single member LLC is pretty cool because that's sort of like a disregarded entity, which all that means is that the tax ID number is the same on your personal taxes. So you can go ahead and buy in John Smith or back into the single member LLC, no issues. Big one to look out for is really multi-member LLCs and general partnerships. If you have any clients holding in this manner and they have co-investors or partners, they need to make sure that everyone's on the same page throughout the transaction to make it successful. Last thing you want is a disgruntled co-investor who doesn't want to move forward or doesn't want to do a 1031 exchange, because the tax ID number has to stay the same for 24 months before the 1031 exchange and 24 months after the 1031 exchange. So that's the real reason why, and that's simply for the IRS's tracking purposes to go ahead and track your taxes from the sale to the purchase. If you change that up, they think it's a new investor, and then that can trigger an audit, etc. So it's always good to keep these details in mind. Replacing debt, this is probably one of the biggest questions I get. Do I need to replace the debt that was on my property I sold? And the answer is yes. You must replace the value of the relinquished debt. That could be a new loan, cash, seller financing, or private money. In this example, $1 million sale, $300,000 loan. They need to make sure they have another $300,000 loan on that new property, or else they could face taxation on that amount. So just something to keep in mind when your investors are looking to purchase one or multiple properties. If they're purchasing multiple properties, just keep in mind they are eligible to spread that loan out however they want over those properties. So if they want maybe a couple properties that are paid off and then one more leveraged property, they can do that. They can split it up any way that makes sense for them financially. So something to keep in mind. You can get pretty creative with it. Vacation homes, I get this a lot. People if they're using it primarily for their personal reasons, they have no rental history on it. That's considered a second home, is not eligible for a 1031 exchange. But if they do, meet these three criteria, then absolutely they can do a 1031 exchange. So ownership for 24 months, establishing that long-term investment criteria. You have to pop it on Airbnb for 15 days of each of the previous 2 years. So 30 days total over 24 months, 15 days in each year, put it on Airbnb. That will give you your eligibility. That's an investment, it's an earning income, and that's what they're required. And then 3, they only use it for personal use in excess of 14 days or 10% of the time it's rented. So if it's rented for 300 days out of the year, you can use it for 30 days. So it's just, I don't know how they track this, but these are the criteria that they want you to meet. And then I leave it up to your client's CPA as to their eligibility. So, with all of the raising property values and people thinking, hey, the 1031 exchange may not be around in the future. Maybe I want to use this this transaction now. So just when they come to you, you really want to help them assess, number one, their tax liability. Just have they spoken with their CPA? Get all those numbers so that they can make a really informed decision. Because that way, you don't have to convince them of anything. The CPA will help convince them the 1031 is right for them because they don't want to pay, all of these taxes. And then you can help them do the sale and the purchase. Number 2, just to analyze their performance. Look at their return, see how you can improve it by buying one or multiple properties for them to help them grow their wealth. 3, maybe they want to diversify. With COVID, a lot of renters were not paying rent, or they were paying the 25% minimum. And maybe they realized, this is my only retirement income, or my only hard asset retirement income. I only own one home. I'd like this to be 2 homes so that, at least I have 2 different people paying me. That way, if one of them doesn't pay me, I'm not losing 100% of my income, So diversification may be the reason, that they're coming to you. They're looking to, diversify their returns or consolidate. Could be the other way around. Getting older, tired of managing single family homes, seems like everybody is, for the terrible T's, the toilets, tenants, trash, and tenants. And then number 4, how many years of depreciation are left. You may have clients coming to you that have owned it for 20 years, 25 years, 30 years, 40 years. They may be out of depreciation. So they may be just looking for some added depreciation benefits, added tax benefits. That could be a huge reason they come to you. And then of course their estate plan. These are just something to think about, when they come to you and they're looking to sell their investment property. If you're knowledgeable on who they need to talk to, when they need to talk to them, that separates you quite a bit from most agents. So the first 1031 exchange program that you're most likely going to use, this is the delayed exchange. This is 90% of our transactions. Used to be 95%. But basically, this is the forward-moving sell first, buy later strategy. It begins with the planning and consulting stage. You're helping your investor talk to all their advisors. They're getting ready to sell. They know their property's worth way more than it was when they bought it. So You list the property. We have one little sentence you put in the contract. It's really easy. When escrow closes, we have to have all the paperwork set up as part of the 1031 exchange. If we don't have the paperwork set up before the close of escrow, that risks a taxable event for them. So the close of escrow on their relinquished property, that's going to mark their time frame. They're going to have 45 days to identify replacement property. Basically, they have to send us a list of addresses by the 45th day. And the way they do that is we'll send them a form. They can identify using one of the two rules listed under the 45 days there, the 3 property rule or the 200% rule. That 3 property rule means they can just list any 3 properties regardless of the value. And then that's probably the most common. You know, you got one primary property on there, one really good backup, and then maybe another backup in case the first 2 fall through. And then you have the 200% rule. And that's if your clients are, you know, looking to identify 200% of their sale price in real estate in value overall. So sell for $1 million, they list $2 million worth of units on there, and that's 4 or more units. So they're maybe leaving the state or going to maybe they're going from the coast really far inland and they need to buy multiple little properties. That would be an option for them, but the 3 property rule is definitely the primary method. And then they're going to have to close escrow on one of those identified properties by the 180th day. So really the transaction is just shy of 6 months. Obviously that first 45 days with inventory today is the most important for sure. But definitely I've seen people definitely identify and were able to close by the 180th day. So it's been a target that's very doable with the right amount of preparation and knowledge. I think that the only time I really see it fail right now is, you know, this bidding inventory. If people are not being aggressive enough, they're not putting enough offers in, they may get stuck, you know, not being able to find a property just due to the quantity of people out there trying to buy every single property that there is. So definitely something to keep in mind, but you'll be better prepared if you're able to get them talking to all their advisors as soon as possible. Simultaneous exchange, you know, if you're able to sell and buy in the same day, it's definitely still possible. I do them very seldomly, but it's still available. This is the one that we're seeing tick up in popularity. This is the reverse exchange. Because of the current market conditions and people being sort of concerned that they're unable to find their replacement property in 45 days, they're opting to pay a little more money to do this program. This is called the reverse exchange. And this will allow your investors to essentially purchase their replacement property before they've sold their relinquished property. So this is a pretty cool program because, you know, it does cost more, but it will allow your clients to guarantee they end up with the property that they want. So their time frame doesn't start until they close escrow on that purchase. Then they'll have 45 days to identify what they want to sell, which most investors have picked that out of their portfolio. And then they have to sell it in 180 days, which, you know, I know very few properties that can't sell in 180 days in the current market. So it's definitely a great program for people who are unable to do the risk or don't want to take the risk. It does cost quite a bit more. It's about $7,500 for our attorneys to structure this transaction. But it's definitely, you know, we have a lot of clients that don't even blink at that fee because it's worth it from their sanity standpoint of not really sure if they can pull off a delayed exchange. But, you know, it's not available to do for anybody in every situation. So it's really going to be situational based on when they find their replacement properties and when they think they're ready to sell. And that's kind of going to define the timing. I've had a couple deals that, you know, they were hoping to sell their property by a certain date. They found the perfect property and the buyer wanted a 15-day close. And essentially they couldn't list their property. They had a tenant in it quick enough to go ahead and make the turnaround. So they did a reverse exchange, even though they only pretty much needed an extra 15 days. But that's really all they had as an option. But it's available and we can always switch it up. If it turns out they're able to delay that purchase escrow and they're able to close on their sale just a day before, then we can get them into a delayed exchange. And that'll work great. And the delayed exchange, you know, it's a flat fee of $950 for one sale and one purchase. So it's a big difference compared to the reverse exchange. But for some investors, you know, for peace of mind, and not to mention it's also part of their non-recurring closing cost as a tax reduction, they're willing to pay that extra fee. And then, of course, we have the build-to-suit construction exchange. A lot of our investors are looking to make capital improvements on their replacement properties. So they might find the perfect piece of land that has a small little structure on it, and they want to add another 1 or 2 structures or ADUs to turn into an Airbnb. And they can do that. They can use 1031 exchange funds to go ahead and build those, as long as the construction is done by the 180th day. So this is also another program, a little more on the expensive end, because we do have to act as the project manager paying out all the contractors. But it's a cool program, and for the right investor, this could be a unique tool for them to use that you can show them. Boot is any cash proceeds remaining after the acquisitions. So pretty much any cash left or debt left that wasn't replaced on the new properties will be taxable, and we'll simply send those proceeds back to them at the end of their 1031 exchange timeframes. Acquiring property out of state, I've never done so many 1031 exchanges out of state in my life. This year has been crazy. I feel like I'm working with escrows all over the country right now. Just for whatever reason, some people are leaving California and they're taking their investments with them. And so it's something to be aware of. Your clients can take their 1031 proceeds out of the state. They just have to file Form 3840 at the end of every year, just letting the IRS, our franchise tax board, know that the property is tax deferred and is out of state. Because if you ever don't file this form, the franchise tax board assumes you sold the property that what went out of state, and then they would like their tax money back from when it was in California. So something to definitely keep in mind. These are the list of non-recurring closing costs. So when I talk about what your investors need to buy to fully defer their taxes, the formula is going to be sale price minus these closing costs. That'll help you arrive at your net replacement value, or what they need to target. And if they're short a few $1,000s or $50,000, etc., they're able to just pay taxes on that amount partially. We call that a partial 1031 exchange. So it's not going to ruin their transaction. It's just going to give them some tax liability. But these are all of the fees that can be deducted. Brokerage commissions, tax advisor fees, transfer taxes, city and county, our fee, referral fees, escrow processing fees, and contractual conditions of sale. So if you have a buyer come to you and say, I need you to replace this roof before we buy it, you pay to replace the roof, that's a contractual condition of the sale, and then you can go ahead and deduct that as well. So these are all things to keep in mind when you're looking at that net replacement value. Partnerships, please consult us. We're attorney owned, several attorneys on staff. We'd love to help consult on partnerships. A lot of them are set up differently, so we like to take a look at the overall setup and just make sure that everyone's on the same page, and that they're all kind of have the same goals, because it can really confuse things if the partners aren't on the same page. I've gotten calls, people trying to sell, their partner has no idea what's going on, and that can get pretty messy. Exchange funds. So, we hold these funds, when a little bit about the process, when your clients sell their property, those funds don't go to them, because that becomes a taxable event. We exist because we hold the funds at the bank in a separate qualified trust account. So, if we do roughly 3,000 of these a year, we open up about 3,000 different qualified trust accounts. The money goes to that trust account until your clients are ready to make their purchase. So the money just sits there. And basically, when they're ready to make their purchase, we'll help them wire those funds to closing escrow on the buy side. So some investors, they come to us and they say, you know what, before this exchange takes place, or I'd love to get $50,000 out of this exchange. I'm willing to pay taxes on it, but I'm not sure if I'm going to need it for my exchange. So I want to keep it in the account just in case. So this is the scenario. So your investor has purchased all their replacement property identified, and the 45th day has passed. Then we can go ahead and return that $50,000 at that point. 46th day comes, it's wired to them, they pay taxes. 2, if they don't identify any replacement property, obviously this is a failed exchange and all the money will be sent back to them. But if they identify a few properties, and they buy one and there's $50,000 left, the IRS assumes they could still try to buy another property. And so we will be forced to hold on to that money for the full 180 days. So they just need to be aware that if they don't exclude the money at the sale escrow for taxes, we will have to hold it potentially for the 180 days, which most investors are fine with. But if they need the money before then we do need to know that in advance. So there's definitely something to keep in mind when it comes to the access of the exchange funds. And this isn't decided by us. This is just decided by the industry, decided by the IRS, that we are not allowed to return those funds before the 180th day. So a little update, I leave this www.1031taxreform.com. This is a great resource to kind of see what the government is looking to do with the 1031 exchange. This is the website that we use, and we hope that maybe you'll go to and click on, there's a take action button. It just does an electronically sends to all of your senators and congressmen, because the Biden family's tax plan currently is set to either eliminate the 1031 exchange as overall or limit it to $500,000 in capital gains. So when we did an analysis of how many of our investors had over $500,000 of capital gains, that was going to be about 40% of our investors. So, that's a huge chunk of not just our business, but of just investors and taxpayers in California that are not going to be eligible or not fully eligible for the 1031 exchange. And then on the other hand, they may end up just eliminating it and switching to like a full expensing model or some sort of way that they think is compensating for it, but is not going to help farmers, and it's not going to help small businesses. It's really something that we're fighting to keep around as the 1031 exchange. And this website is very helpful for learning more about what they're trying to do. But coupling the 1031 exchange elimination with a couple of the other tax increases, as well as some of the benefits that are proposed to be taken away, such as step up in basis, which, as the 1031 exchange, if your investors do a 1031 exchange, they keep deferring their taxes. When they pass away, their heirs will get a step up in basis currently under the model, to where their heirs, basically their taxes die with them. So their heirs don't owe any of those taxes, because, I have a lot of friends that they might inherit properties that they can't even pay the property taxes on. And so it's going to force a lot of sales, or it's going to cause people to just hold on to their properties indefinitely. I think that's why we're getting such an increase in business. Our business is up 30%, because people are concerned that the current asset they're currently holding is not an asset they want to be holding long term. So they're looking to do the 1031 exchange, get into a property that they're comfortable holding potentially forever or for a long time, because they figure they may not have another opportunity to sell it or to roll it over or to do anything with it. And so this is their opportunity now to go ahead and do that before this law goes up for voting, and just to see, because they may end up, if they vote on it, instead of waiting to January 1st to institute it, they could make it retroactive, meaning that the day it got voted on, basically anybody doing anything after that day would be ineligible. So it's one of those things where we're just getting this huge influx in people doing 1031 exchanges because of this. So I don't know if you guys have seen that in the market, or you've seen, a lot of people trying to buy properties and park their cash and make all their moves now, knowing that they're not really sure what the future holds. But we're here for any of your clients that are looking to do this. Even though we're really busy, our customer service is still top notch. We're still here to answer any of your questions, to provide advice for your clients and be there for them as a resource. Please let me know if there's anything I can do. Thank you again, Travis, for having me come in today. I'm very excited to be here and just to talk about this tax reform, and hope to get your guys' support, because a huge part of the economy and the real estate transactions, in our world, and the amount of people employed off of 1031 exchanges, from title to escrow to inspectors to everybody, to brokers, it's a big deal, and it's going to be a big industry changer if it passes. So thank you so much, and please let me know. I'm here to take any questions if anybody has anything they'd like to ask.
Yeah, I just gave everybody the ability to answer any questions if anybody has any. So, yeah, I agree. I've definitely seen an uptick in the 1031 recently. So I think the timing of this is pretty good. This webinar, just as a refresher for everybody, and also, the information of where to go to look for updates is also very useful.
Exactly. Well, thank you, everyone. I'm just going to do a quick little raffle here. How many people are in the meeting?
Can we get the slides of this?
What was that, Shivanan?
Can we get the slides? Whatever it was presented,
Oh,
can
the
we get the
slides.
slides? Yeah.
Absolutely. I will send those over to Travis for sure.
Okay, sure. Thank you.
Random number 9. Oh, well, I'll go to the next one. All right. Rosa Ortiz, if you wouldn't mind sending me your email, you won the $25 Amazon gift card today. I will go and send that to you online using your email. And thank you all so much for tuning in for this 1031 Exchange webinar.
Yeah, I really appreciate it, Adam. We'll talk to you soon. Okay. Thank you.